$500,000 in death benefits could vanish into taxes if your company never sent one form, and most don't. If your employer has taken out life insurance on you as a key employee, the IRS has a hidden rule that determines whether that payout is tax-free or ordinary taxable income. It's called IRC Section 101J, and failure to comply could cost your beneficiaries $185,000 to $295,000 in federal and state taxes. No warning, no grace period, no appeal. Most high-income professionals assume employer-paid life insurance is always tax-free. That's wrong. The correct reality is this: IRC 101J requires the employer to provide written notice identifying you as the insured, describing the policy, and obtaining your signed written consent before or at the time the policy is issued. No notice, no consent form on file, no compliance. The delta, $500,000 death benefit taxed at your beneficiary's marginal rate of 37% federal plus state could cost them $225,000 to $250,000 they never planned for. That's the outcome gap nobody talks about. Here's the first concrete issue. Many companies have had employer-owned life insurance policies on executives and key employees for 5, 10, even 15 years without ever sending written notice under 101J. The IRS published Notice 2009-48 clarifying the rules, but your company's benefits team may have missed it, ignored it, or simply never implemented it. If you've changed jobs internally, been promoted, or transferred departments, your policy status may have drifted into non-compliance without anyone flagging it. Let's examine what the IRS actually requires. Treasury Regulation 101-1C is explicit. The employer must provide the employee with written notice of the insurance arrangement before the policy is issued or at the time it's issued. The notice must identify the employee, describe the amount and type of insurance, state that the employer intends to be the beneficiary, and inform the employee that the death benefit will be subject to income tax if 101J requirements aren't met. Then the employee must sign written consent. That's the anchor, written consent on file. No signature, no compliance. Now the hidden detail. The IRS doesn't require the company to file Form 8821 or any special form with your return. They don't require annual filings or updates unless your coverage amount or status changes. This means the compliance failure is silent. You won't know until after you die, when your beneficiary files their return and discovers the entire death benefit is taxable ordinary income. By then, it's too late to fix. Consider this scenario. A CFO earning $180,000 per year has a $500,000 employer-owned life insurance policy. Her company took out the policy 5 years ago to protect against the loss of key talent. The company's benefits team never sent notice under 101J or obtained written consent. 10 years later, the CFO passes away. The company pays the $500,000 death benefit to her spouse. The spouse's CPA files the 1040, and in April, the IRS matches the policy proceeds to the employer's records. The spouse now owes federal income tax on $500,000 at a combined federal rate of 37%, plus state taxes ranging from 5% to 13%, depending on where they live. Total tax bill, $210,000 to $325,000, due by April 15 on top of regular taxes. The spouse expected $500,000. They owe $75,000 to $290,000 instead. Here's what to do starting today. Request written documentation from your HR or benefits team proving that your employer has complied with IRC 101J. Ask for the notice letter and proof of your signed written consent. If they can't produce it, that's a red flag. If they say, "We don't have that documented," or "We didn't know that was required," your employer is at risk of non-compliance. Contact a licensed tax advisor or estate planning attorney immediately, not to sue your employer, but to understand your options. Some advisors recommend working with the company to issue a retroactive compliant notice with signed consent, though the IRS's acceptance of retroactive compliance varies. Don't wait until a death benefit is paid to discover this gap. Second step, if you're changing jobs, leaving the company, or retiring, request explicit written confirmation that any employer-owned life insurance policies on your life are being terminated or transferred with proper compliance. Don't assume silence means everything is fine. The research confirms this. IRS audits of employer-owned life insurance arrangements are increasing. The Treasury is focused on Section 101J, compliance, as a potential source of unpaid tax. Companies that can't produce notice and consent documentation face penalties and interest on the unpaid tax. Your beneficiaries bear the cost. The takeaway, employer-owned life insurance on you is not automatically tax-free. It's tax-free only if your employer complied with IRC 101J. Most companies haven't. If you've never seen written notice or signed consent, assume non-compliance and take action now, before a death benefit triggers a surprise tax bill your family wasn't expecting. For the full compliance checklist and the exact regulation citations you need to discuss with your tax advisor, check the companion resource in the description. If this changed how you see your employer's life insurance, hit subscribe. We're covering step-up basis loopholes and HSA estate planning hacks in the next video dropping Wednesday. Ring the bell so you don't miss it. What's your biggest takeaway? Drop it in the comments below. The tax code rewards those who study it.